Welcome back, you legends. I'm Dr. Cal. Let's get right into this quick update video. Today we've got a lot to talk about, so let's get right into it. The S&P 500, the Dow, and the Nasdaq all down today after a major dump in the first 30 minutes of trading, all thanks to this number right here, the JOLTS job openings. We had 500,000 more job openings than what we were anticipating, and more job openings means a hotter job market. And a hotter job market means more inflation, which in turn means the Fed needs to hike rates and be even more aggressive. Let's take a look at the different sectors leading today. Were basic materials, energy, financials, and utilities. Basically, the risk off and the inflationary sectors were up. Basic materials and energy, both inflation-driven sectors. That makes sense. A tight labor market means high incomes for workers, which in turn means more spending power, more inflation, etc. The weakest of the bunch were again the risk-on sectors, communication services, cyclicals, and technology. Let's take a look at the daily chart for the S&P 500. We have a classical reversal style candlestick pattern here. A massive green day, an indecision candle, and a reversal to the downside. Now, typically, this reversal pattern would need for the red candle to close at the bottom of this green candle to form a tombstone formation. But nonetheless, this, from a psychological perspective, is still a typical reversal structure. However, it needs confirmation the next day, because right here we also had a typical reversal structure and the market rallied the next day. Tomorrow, everybody, will have the most important event. At 2 p.m., we'll get the Fed interest rate decision. We already know that's going to be 75 basis points. At 2:30 p.m., we're going to get the Fed press conference. Watch very closely and listen very carefully to what Jay Powell says. I suspect there will not be any pivot, any talk of a pause, just a reiteration of the current hawkish policy. We have a job, we'll keep at it, blah, blah, blah. No pivot. The market could still rally tomorrow, everybody. The market could still rally tomorrow and make a top tomorrow. There's a 50-50 chance of today being the top or tomorrow putting the top. Why? Well, let's take a look at this. This is the HYG up top, the smart money. Down below is the dumb money, the S&P 500. And we have now established a very clear, very obvious bearish divergence where the HYG has put in successive lower highs as the S&P has put in successive higher highs. The last time this happened was back here, everybody. Look at this. Lower highs, higher highs, and it marked the top. The prior time it happened, it also marked the top. Before that, it also marked a significant reversal. So these bearish divergences have years to date always led to significant sell-offs, and in most cases have marked the top. As soon as I spotted this, I talked about it immediately in the trading community. Right over here, I alerted everybody 10 minutes after the market opened. By the way, I'm at UTC +3, so 4:40 p.m. for me is 9:40 a.m. Eastern time. Dumb money up top right here. Smart money down below right over here. Divergence complete. Beware, a crash is now just days away. I decided to book my Tesla profit and not risk it here. We booked profits on 2 open trades on AMD and Tesla today. So we're starting the month with 2 nice profitable trades. In fact, one of our legends today had their best trade of the year on Tesla, closing it with a $12,000 profit. Another legendary trader also closed a different Tesla trade, a more aggressive Tesla trade with a 70% profit. Another member booked a 500% gain. I mean, we have some truly exceptional traders in this community. I'm so blessed and so happy when I see people booking profits, insane profits like a 500% gain in a single day. That's absolutely beautiful. Congratulations, everybody. By the way, everyone, this is what the trading community looks like. This is where I post all of my stuff, all of my trades and my analysis, as well as my weekly watch list and my charts, a library of all of my charts, all of the charts that you see in the videos. I'm building a live library with a live link to each one of those charts, so you can click on whatever chart you want to see, S&P, Qs, the VIX, my CPC buy and sell signal, my Dow theory chart, my HYG smart money and dumb money indicator, all of those charts will be right here. We also have a plethora of other member sections, including our legendary trading room. All of the details will be in the link in the description below. It will take you to the welcome page to sign up. It's $30 a month if you go for the annual membership. And it's the best way to support me if you want to do that, and the absolute best way to track all of my work in real time, as well as all of my trades and investments. Now, in addition to this ugly looking divergence between the S&P and the HYG, which has now year to date marked pretty much every single top and every single major reversal, we also have another nasty development, and it's this, everyone. Look at this. This is the Dow Jones Industrial Average, and we've tagged the resistance line. Systematically, every single time we tag this resistance line, the stock market sold off just a few days later or on the same day. Another major warning sign of an imminent crash is Dow theory. This is the Dow theory chart. Down below is the Dow transports, up top is the Dow Industrial Average, and every single time the Dow transports have put in a lower high as the Dow Industrial Average has put in a higher high, it marked a significant reversal in the market. Here's an example. High, lower high, market sold off. High, higher high, market sold off. Another divergence right here. Higher high, lower high, market sold off. Another divergence right over here. Higher high, lower high, the market sold off. Another one right here. And this one marked the top and the beginning of the bear market. Another key chart to look at is the VIX. The VIX is now slowing down. It has printed 3 flat days so far as the market has weakened and continued to weaken. It is now sitting at a very logical level, just below the 50-day moving average and just below the 200-day and 125-day moving averages, as well as a level where we had a lot of support in the past. And so we are likely to see the market sell off tomorrow on the Fed meeting, or we could see a fake out rally in the S&P 500, one last push and then a sell off. Either one of those possibilities is reasonable, but in either case, please be careful. Don't get trapped in this imminent bull trap and subsequent crash. Let's take a look at the dollar index. And again, remember guys, I talked about this in the last video and last couple of videos. I think I mentioned that every single time the dollar index has put in a low with a big green candle a few days later, that usually marks the top just a few days later. Right here, mark the bottom, 2 big green candles, and mark the top right over here, everybody. We had the bottom, 2 big green candles, and it marked the top in the S&P just 1 day later. I marked the signal yesterday. It's just an observation that I made, and that's what I noticed. Every single time we put in a low in the dollar with 2 big green candles, we had the top. And so from a psychological perspective, from a psychological point of view, it's just that the dollar has bottomed. Money's flowing out of risky assets into the dollar as a safety asset. Let's take a look at yields. Yields have now appeared to have formed an intermediate bottom. Now, even if yields continue to sell off, the stock market could continue to sell off. The correlation between yields and the Nasdaq has pretty much broken down in this last leg of the rally. In this entire up move, look at this aggressive up move by the S&P, and now look at this pathetic looking bear flag looking move to the upside. It's way more anemic. The rally has been more towards the industrials, the Dow Jones, significantly less so in the Nasdaq. This is very atypical. I talked about this in my last 2 videos. Up top, everybody, is the ratio between the triple Qs and the Dow Jones, and down below is the S&P 500. And I just want to point out something very obvious. Look at this, a rally in the S&P. It's led by the Nasdaq outperforming the Dow Jones. Another rally right here, led by the Nasdaq outperforming the Dow Jones. Look at this last rally. It's been led by the Dow Jones with a massive underperformance by the Nasdaq. This is very bad news. There was hope that we could have been bottoming in this ratio, but just look at this, 2 consecutive massive red candles, a new low today on this ratio. And this is a major red flag. This is a major red flag. Every single rally in this bear market has been led with risky assets, with the riskiest assets, the Nasdaq, the growth sector in the market, leading except this last rally, which highlights how much the market is skeptical at this point. It has not been buying up big cap tech, especially after those disappointing earnings. And we are seeing that with these big red boxes on these big cap tech companies. And it's even more obvious if we take a look at the weekly performance: Microsoft, Google, Meta, Amazon. The stocks that you would expect to lead the market in this rally have been going down. So the internals of the market have been breaking down. That was a major red flag that I talked about in last week's video, and we're continuing to see that happening. The CPC buy and sell signal, my own variation of the put to call ratio buy and sell signal, this variation has been 100% accurate year to date in marking stock market reversals. The classical version of this signal has been significantly less accurate. So I've been working on this specific variation for this bear market, and that's why it's been incredibly accurate. We have now crossed above 95, and so as soon as we see a cross up on this PPO, that will trigger a sell signal. Let's take a look at the fear and greed. We are in greed territory. We are seeing a rejection near the 125-day moving average. We could still tag it tomorrow and then sell off, or we could just sell off immediately. Just be very careful. Do not be sucked into this bull trap. Let's take a look at the put to call ratio. Put to call ratio, head and shoulders formation that I talked about. We have now based, and it appears that the put to call ratio wants to start moving back up to the upside. Market volatility flattened, will now likely try to move again to the upside. If not tomorrow, it will likely happen on Thursday. Safe haven demand has actually been moving up. Stocks have been now underperforming bonds for the last couple of days. Junk bond demand has now been declining, with the yield spread between the investment grade and junk bonds moving to the upside. When this chart moves to the upside, everybody, it just means the market is more risk off. It's taking risk off the table with less and less demand for high yield bonds. And we're seeing that live, right? We're seeing now 3 consecutive days of weakness in high yield bonds. In terms of earnings, AMD reported today. We already knew the numbers. They had already reported a miss in the first week of October. They pre-announced the earnings results. I was looking at the forecast, and the forecast does not look pretty. It does not look pretty at all. Keep in mind that AMD as a company has been growing revenues at 60% per year for the last 5 years. They are now expecting revenue to be up by 14% next quarter. That's significantly below its historical growth rate and significantly below this quarter's revenue growth of 29%. So the slowdown is real, the slowdown is vicious, and we will likely even see declines in the business as we get deeper and deeper into the global economy weakening, and as the economy flips from overheating to a deep recession next year. Let's take a look at tomorrow. Again, Fed press conference at 2:30 p.m. That's going to be the most important event tomorrow. ADP employment change, that's going to be very important as well. Be warned that if we see more jobs added than forecasted, again, be warned, the market will not like that. That will indicate an overheating economy, especially in terms of inflation. Thursday, we'll have balance of trade as well as ISM services, PMI. And Friday, we'll have the most important figure this week, and that's going to be the unemployment rate. If this ticks down, that's going to be almost apocalyptic for the stock market, because everybody is hoping that inflation has stopped. But if we see the jobs market tightening even more, that will signal that at least the core part of the inflation equation might come roaring back up, and that the Fed will need to hike rates even faster and harder. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.